We definitely subscribe to that view. I talk to company after company, especially the ones that are outside the AI realm. And, a lot of the companies, just give you an example, waste management company, which depends on industrial production, housing growth, the volumes haven't been there. The demand hasn't been there for a number of years. So I think there is this anticipation that monetary easing cycle will actually make that handoff to a broader based recovery and bring that relief that's needed to so many different sectors of the market.
To your view, are the fundamentals there for the rise we're seeing in AI related companies, or is this really a case of animal spirits and a little FOMO at action?
It's both, right? So the fundamentals are there. Just, I was looking at the Bloomberg terminal, looking at the earnings growth, and everybody talks about how great the earnings season was. Yes, it was. Earning companies have gone so good at figuring out the game to like just guide appropriately and then come out and beat that. But if you look at where the growth has come from, it's been pretty much concentrated in AI and AI related infrastructure, right? Outside of AI, there's so many sectors that have not participated: healthcare, industrials, so many other sectors, retail, autos, not participated. So, when we say that the AI rally, yes, the fundamentals are there. Those are the companies that have been showing the growth. They've been carrying the economy. Almost a third of the GDP growth has come investments. So the fundamentals are there. Are they there in perpetuity, which is what the animal spirits seem to be baking in? That's yet to be determined.
We're making seemingly all-time highs on a daily basis here, Nimrit. In September, it's supposed to be kind of a rocky month, September and October. I don't know. Does that surprise you?
It really does, Paul. We had called for a little bit of breather, consolidation. We've been sitting on the sidelines with some of the ideas that we want to take positions in, but we haven't had that opportunity with the market making all-time highs basically every day. And that kind of tells you what's in play here. There's huge FOMO aspect coming on here. The momentum index is up significantly. And one of the things that I often hear is, institutional investors, they want to have allocation to their equity portfolios. They're going through the passives, and when they go into the passives, it's basically going back into the same names and fueling the rally that we've been seeing so far.
So, okay, obviously you need to be in equities, right? I think we've established that there's a lot of FOMO there, so people keep piling in. But what about fixed income? Not nearly as sexy, but where do you see opportunity there?
We actually think the fixed income is an excellent diversifier to the portfolio. If you look at the Barclays Ag, you're almost looking at 6.5, 7%
Hold on,
return.
hold on,
That's
hold on, hold
pretty.
on. That is the Bloomberg egg.
That is correct.
Ah,
Thank you so
There you go.
much.
We spent good money for that.
Uh, And that's right, right? So, and if you look at the rate cutting cycle, that also bodes well for the fixed income portfolios. Other than the yield, you also get some price appreciation there with the cutting cycle. So we think that that's a nice hedge to your portfolios, diversifier. Now, where we are, we like to play in the belly of the curve, that 5 to 7 year maturity. Why? Because I think if you are in the short end, you face the reinvestment risk there, especially with the Fed cutting. The longer end, we're a little reluctant to tie up our clients'
Mm.
money, lending to the US government or others for more than 10 plus years period because of all these secular headwinds that we see with rising deficits and inflation and so forth.